Yo, what is going on, guys? Welcome to the Journey Podcast. What I want to do today is talk about taxes for business owners. Now, this is going to be a really like kind of introductory training. I am going to give you guys a couple of resources to look into, and I do recommend that you guys talk to a professional. This is just information that I've learned, being a business owner myself, speaking to CPAs, studying taxes, but I am by no means a professional. And this is not financial advice. This is just advice off my own experience. I could be wrong about a couple of things, so I definitely recommend looking into all of these things yourself. But I know a lot of you guys are getting started with your coaching business, or you have started your coaching business, and this is going to be your first year paying taxes. And I know that can be really scary. For me, for a very long time, my mom was always in my ear. Well, if you own a business, what about taxes? What about taxes? I'm like, Mom, I'll figure it out later. Like, don't worry about me. But in reality, I was like scared shitless because I didn't know anything about taxes. And so I took it upon myself to learn. And when I learned, I realized that it's not as bad as you think. It's never as bad as you think. So we're going to go over pretty much the foundational ground rules for it. And, I'm not going to get into any like tax strategies or anything like that, just because that is a little bit beyond me. But we'll go over the basic concepts of like how it works, what you should look out for, and how you should be best prepared for paying your taxes in 2022. Now, I am going to give you this example as if you're starting your business in January. Today, right now, it's January 6th. So January 6th, you're starting your business. So you actually don't pay any of your taxes until April of the next year. So I won't be paying taxes for 2021 until April 2022. And I won't be paying taxes for April 2022 until April 2023. Now, you can pay quarterly or you can pay annual. Quarterly is at the end of each quarter, every end of each business quarter, which in the calendar year, there's 4 quarters. So every 3 months, you can pay into your taxes. Now, the biggest difference between paying taxes as a business owner versus paying taxes as an employee is that when you're an employee, what happens is your business or the company that you work for pays your taxes for you and takes it out of your paycheck. So for each paycheck you're getting, they're taking your taxes out already, which is why you don't have to pay any taxes, because they already take it out of your paycheck before you even get it. And then at the end of the year, if you didn't make as much as they predicted, then what they'll do is they will give you a refund on the money that you already had paid into. And so now, when you're a business owner, the thing is when you're charging clients and you're getting paid for your services, you're not paying taxes on that, right? It's not like you are prepaying your taxes and getting a paycheck that's already prepaid. If you make $1,000, you haven't yet already paid taxes. And so what you need to know is that part of that income is going to be taxable. It's a messed up saying, but I say, part of that money is not yours, right? If you make $1,000 signing a client, unfortunately, part of that money is the government's. And so where people make mistakes is that they think that $1,000 is theirs and they go ahead and spend it all. And the government's like, well, you owe $300 on that $1,000 of taxes. And you're like, well, I don't have it anymore. And they're like, well, you better go get it. And so that's where people get into a hole, is that they don't actually prepare, they don't save, and they don't spend the money, or they don't save the money in order to best prepare for taxes. And so we're going to go over, quarterly annual taxes and then annual taxes. So as you're making money, let's say the first 3 months of 2022, you make money. If you're going to pay quarterly taxes, then what they're going to do is look at your first quarter. They're going to predict how much you're going to make throughout the year based on how you did that first quarter. And then you're going to be paying a percentage of your taxes based on those earnings. And so what will happen is every single quarter you will do that. And at the end of the year, they will look over how much you actually made versus how much you actually paid. And if you're off by any means of the prediction, then you'll either pay into the taxes more or you'll get a refund. A refund is when you pay too much taxes and they're like, hey, you actually paid us more than you needed to. Here's your money back. But paying into your taxes is, hey, you didn't actually pay us enough. You didn't pay us enough. We're going to need a little bit more to match what we have here. So paying quarterly taxes is great because you kind of just get it out of the way and you don't have to pay a big chunk. Paying annual, you're going to be a little bit more accurate with what you're going to pay. Like, you're not going to get a refund or not going to, have to pay into it because you're taking what you owe at the end of the year. But it does take a huge chunk out of your savings, because you just have to make sure that you're saving money. And so one thing I would recommend is, as long as you're saving, or as long as you're saving money, you guys are going to be good. As long as you understand that the money that you're making in your business, not all of it is yours, and that you do have to save some of it for taxes, then you're going to be all set. Where people really get messed up is when they make, like, let's say that they make $100,000 in a year, and then they spend $100,000 in a year, and the government's, well, you owe $30,000 in taxes, and that's a lot for taxes. You won't owe that much, but you're like, oh shit, I don't have $30,000 to give you guys. And then they're like, well, you better pay us or else, right? And so then you have to go make $30,000, and then the $30,000 that you make to pay back the government also gets taxed, so you have to make more than $30,000. And so just save your money, make sure that you're saving enough for taxes. If you want to start doing quarterly taxes, then what I recommend is talking to a CPA and have them get you set up with quarterly taxes. And then if you want to do annual taxes, again, talk to your CPA about filing. I highly recommend just doing it yourself. You could do it yourself with TurboTax, but I have a CPA and it helps me out a ton. Now, the next thing I wanted to talk about was an LLC, right? So does an LLC help you with taxes? Unfortunately, in most places, LLCs do not help you with taxes whatsoever. In the beginning, you are going to be taxed as self-employed. Whether you have an LLC or not, your taxes are still going to be taxed as self-employed. Now, what an LLC does is, an LLC, one, protects you from like any legal battle. So like if someone were to sue you, they'd be suing your business, and you have a protection of the LLC. So that way people can't sue your personal assets. So an LLC is good to have just for legal reasons. It's more of like an umbrella, like a protection mechanism. And then the other thing is, with an LLC, you can actually open up a business bank account, which I do recommend doing, opening up a business bank account. So that way, you can have money flowing in and flowing out of there. We'll talk about that in just a second. But I want to let you guys know that when you're starting your business, you don't need to have an LLC to pay taxes, and having an LLC isn't going to make a difference on taxes either way. You're still going to get taxed as self-employed, whether you have an LLC or not. So just know that with taxes, LLC doesn't make a difference. Now, if you were to go up a notch and you were to get an S Corp, S Corp's a little bit different, because what you do is you hire yourself as an employee under your business. And so now it's weird. So with an S Corp, your business is producing the income, and then you're paying yourself out as an employee. And so what you pay yourself out as an employee is taxed as, personal income or employee tax. That's taxed at the regular amount. But then the rest of the income that came into the business that you still own, but is technically the business's, is taxed at a different level. I'm not sure, the specific amounts, but that's the concept of it. Is like the money coming into the business is taxed at a certain level, and then the money getting paid out to you is taxed a little bit higher as like employee tax. But that's kind of how you get around everything just getting employee taxed, right? So it's a little kind of a loophole. Now, when it comes to tax strategy stuff, there are ways to get around taxes. It's just super, super complicated. And for anyone who's listening here, it's just a little bit too high level. So just accept for the first, couple years of your business, you're just going to be paying taxes no matter what. You can get those taxes lower through write-offs and stuff, but for the most part, you're going to be paying taxes. It's just, the game we have to play. But we're going to talk about a business bank account. So what a business bank account would allow you to do is separate the income coming in from your business and that your personal income as well. The reason why this is important is because it just makes things easier when you're keeping track of your books. One of the most important things that you need to do as a business owner is keep track of your books. This is the number one most important thing that you can do as a business owner. And we're going to teach you how to do that. I have to take a sip of water. Also going to plug in my charger. Okay. So in taxes, there are things called write-offs, right? And you've probably heard people talking about write-offs before. Essentially, what a write-off is you can write something off as a business expense. All right, let's say that you take a couple clients out to dinner. Let's say that you buy some new gym clothes. And if you're a personal trainer, gym clothes would count as a write-off. Let's say that you buy some equipment for your home gym. for content. Those would be write-offs. And so what write-offs does is you can take that expense out of the business, and then that reduces your taxable income. Now, a write-off is not a dollar per dollar like reducing of your taxes. It reduces your taxable income. So I used to think that if I'm going to owe $50,000 in taxes and I spend $10,000 in write-offs, then I'm only going to owe $40,000 in taxes. That's not how it works. How it works is, imagine that you have $10,000 that's taxable income, right? Now that means you're going to get taxed on $100,000. But then let's say that you spend $15,000 in write-offs, that reduces your taxable income to $85,000. So now instead of getting taxed on $100,000, you're going to get taxed on $85,000. So you're still going to get taxed, and it's not a dollar for dollar amount. It's not like you're going to get $15,000 in less taxes. It just reduces your taxable income. And so it's essentially anything you spend on the business comes out of your taxable income. So that's what write-offs do. And obviously the idea behind write-offs is to invest your money into things that are going to produce more income for your business. For example, in 2021, I was going to pay maybe like, I'm not going to get into the number. It was a lot of money, multiple six figures. I was going to pay a lot of money. And so what I figured, I was like, if I'm going to spend $50,000 in taxes, I might as well spend $50,000 in a new business coach and a new mentor to help me make more money in 2022. And so I spent $50,000 in December on a new business mentor to just bring down my taxable income, but also it's going to produce an ROI in 2022. So that's like what you want to think about with business expenses. Don't go crazy with it because you're still going to owe taxes and at the end of the day. But if you're going to buy something, might as well buy something that's going to have an ROI and that you can write it off on your business. Now, when it comes to keeping track of your books, this is like the number one thing that you need to keep track of. Because when you work with a CPA, they can do so much of like the filings and all that kind of stuff. Now you can do it yourself on TurboTax. I just, recommend paying someone to do it. It's just so much easier and less of a headache. And so what you can do is you can get QuickBooks, right? QuickBooks is an app that's $15 a month. It syncs up to, your bank accounts. And if you have a business bank account, then it's syncs up to literally all the bank accounts you have, your business, your personal, your credit, like everything in one platform. And it will give you a running track of all of your expenses, your income coming in and your expenses coming out and all the cards that you use. And so at the end of each month, what you can do is you can just swipe right if it's a personal expense, or you can swipe left if it's a business expense. And so that way you can categorize all your expenses and also all your income as business and personal. And it will keep a running track of like how much write-offs you have per year, how much income you made. And those are really the only numbers that you need to give your CPA. Your CPA will let you know how much you'll owe based on those numbers, and then they can help you file your taxes. So it makes it super simple. Where people get messed up is that they don't keep track of their books whatsoever. And then in December or in the first few months of the year, they have to go through every single transaction from January to December and determine whether or not it's an income, whether or not it's personal, whether or not it's a business expense. And so that can be a drag. And I had to do that one year. It wasn't fun. So what I would recommend is just downloading QuickBooks, get it synced up to your accounts. And then at the end of each month is super simple because you only have to track 30 days. You just decipher what's business, what's personal. Then at the end of the year, your tax accountant will look in and be like, okay, cool. Everything checks out. Here's what you're going to owe. And then you have to pay the money, unfortunately. So that's pretty much the basics for taxes. Like I mentioned, if you're getting started with your business, what you need to know is that you are going to be paying taxes no matter what. There's complex tax strategies and loopholes to get out of things, but for the most part, like it's pretty complicated stuff. So I would just keep it simple. Keeping it simple just looks like, having an LLC, which will help you open up a business bank account. You can put your income into there and pay yourself out of that. Keeping track of your books. So income, personal, business expenses. And then what else is there? I mean, that's pretty it. It's pretty simple. Just understanding that you're going to get taxed on your income and that you can write off your taxable income with business expenses. So that helps. And then also hire a CPA because, They're very, very helpful. Now, if you want to learn more about taxes, there's a really, really fantastic book called Tax Free Wealth. I highly recommend it. Highly, highly, highly recommend it. After I read that book, I felt like very, very confident in, my tax strategies and what I understand about taxes. So definitely recommend giving that lesson a listen or giving that book a read, not lesson a listen. But with that being said, guys, we'll catch you soon. Peace.